And we're ready to go. Today we've got two major things I want to talk to you about. I want to talk to you about gold. I'm going to talk to you about a very important currency. And you may think that the currency I'm going to talk about doesn't concern you, but the implications of currency movements are so massive for all of us that you really need to develop a very acute sense of what currency movements can do to your wealth and affect pretty much everything you're doing. Sage, give me another sound check, would you please? Is everything okay here? Can everyone hear me fine since we came back on? Oh, good. Lots of people. Thank you. Brian Coleman. Hello, Brian. It's our new man in New York. I'm going to be telling you a lot about this guy in a few weeks, perhaps. Good. Okay. Let's first of all, I wanted to just show you this question of time cycles inverting. You should see the new chart any moment now. There it is. And this is the S&P, and this is the index of the S&P. You can use the index or you can use the continuous futures chart. You'll get very much the same result. Wherever possible, I like to use the index for our timing cycles. At least I actually run both the index and the futures. But you can see here, right at the left-hand edge of the chart, that's October 2007. That's the high before the crash that led to the global financial crisis. That was not global, and it certainly wasn't a financial crisis. It became one for a lot of countries, but not here in Australia, although an incompetent government overreacted to all the noise and hysteria, like a lot of traders do, and threw billions and billions of dollars at an imaginary problem. And due to the gross incompetence of all politicians generally, they lost it, pretty much all of it, on crazy schemes. Anyway, long story short, start the left-hand side. There's the October high in 2007, and that came in on a Daniel Code 59 cycle. This is the 6-day chart, which is our primary timing chart. We have techniques we can do this on daily charts as well, but we start off with the 6, 12, and 24-day charts. The 6 is the most useful most of the time. When we get really big, serious, swoopy moves, then you've got to move out to the longer-term charts to identify them properly. But there was the high, and because we had a 59 cycle at the high, the 59 is the dominant cycle for highs, 62 is the dominant cycle for lows, 44 is the cycle for gold. If you don't know about this stuff, have a look, please, at the Daniel Code website. Click on articles, and you'll see about 100 or something odd articles I've had published there, and particularly read the two called Masterclass 1, it's about time, and Masterclass 2, Timing Gold. And that will show you exactly how I create these time cycles, what they mean, and what you can learn from them. One of the first and most basic techniques is you see a time cycle occur, and you look for it to repeat. And it does, and it will, and there's lots of evidence for that. So following on from that 59 high, we look for a recurrence of the 59 cycle, which came in March 2009 on the 6-day chart, and that, amongst other things, was one of the tools I used to forecast the crash low to the day and to about a couple of points. 666, the number, the mark of the beast, was the low on the S&P. You can see then, and we know that for these cycles, we're told it shall be for time, times, and then half. So it goes on once the cycle is established. It goes on repeating in cycles and half cycles. And these numbers you see running along the top here, 59, 118, 177, 207, on they go. They're all half cycles or full cycles of 59 because it repeats. And you can see that in March 2009, it gave us a low. These cycles are accurate to plus or minus one period. And that's because they can start, it's valid to start them either at a bar high low, remember we're talking 6-day bars here, or on the closing high or the closing low, which is often the bar before the chart high, chart low, and that's why they're valid for plus or minus one period. And if you understand that that comes from where the count starts, they're actually pretty much accurate to the day. So coming out of our 2009 low, you see we had a small high on the 117 cycle. One before the chart high, we actually got the closing high on the 207 cycle, then it skipped a cycle. 266 gave us the chart high at the median. 295 gave us the next high. And 325, I should say, gave us a low. And the next cycle, 354, also gave us a low. So these cycles have inverted. They should be giving us highs. Typically, the 59s give you highs, and now they're giving you lows. What does it mean? Well, if you go way back to 2009, you can see that that very, very important crash low itself came on a 59 cycle. So they can invert. They have inverted in the past, and no doubt they will invert again in the future. But it's pretty unusual. And what it's telling us, you can take two views of this if you're a conspiracy theorist. And, you know, I love conspiracy theories. I don't believe in any of them, but I love them. I think they're jolly great fun. But if you're a conspiracy theorist, you could say, oh, well, this is the false liquidity provided by the Fed that's propping up all the markets. And these time cycles should have given us highs, and in fact, they're giving us lows. That's the fun view you can take, and this will give you something to talk about at your cocktail parties or at the golf club. But the reality is sometimes cycles just invert. I actually like the argument that this market has gone far too far, and it's gone, as you can see, in right within the Daniel Code trading channel. This idea of random walk is an absolute nonsense. If you want any proof of it, have a look at this chart. Here's the S&P, probably the biggest futures market in the world. And it has run from the March 2009 low completely within the Daniel Code trading channel. It's had several visits to the one standard deviation on the downside. Early in the rally, it had some runs to the one standard deviation on the upside. And then in one period there, the only period where we've actually had a decent correction, which is here. These are your one standard deviations. This first line, these are the movement through the one standard deviation there and there. And these are the one standard deviation on the upside. 1, 2, 3, 4 times there, a couple of times here. And the only decent correction we've had here, way back in September 2011, that correction went exactly to the 2 standard deviation line. And since 2011, we have not had a correction better than 1 standard deviation. And indeed, we can move on here and say that since pretty much the end of 2012, we have not had a correction even to 1 standard deviation. So this is an extraordinary market. This Daniel Code analysis stuff is extraordinarily precise. And as you can see, it's happily wafting along either side of the median. So at the moment, there is absolutely nothing dramatic about this market at all. It's just continuing to do what it's done since the low. It's running up the Daniel Code trading channel. And once we start getting a reasonable or serious correction out of it, you'll be on top of it, because we'll let you know what's happening. So I just wanted to share that with you. Let me move on now. And here's our compliance statement, folks. Jerry gets very cross with me. Jerry Winters, our broker. Jerry gets very cross with me if I don't show you the compliance document, and you should be aware of it and take it all very seriously. There is a large risk in trading futures, which is precisely the reason we do it, because there's no reward without risk. And I've just got the final page of this document to show you, which is if any of you would like a free trial of anything, you just need to register. There's a register button at the Daniel Code website. Then you can, once you've done that, if you'd let Terry at support@thedanielcode.com know that you'd like a free trial, he will turn you on for a free trial of everything. The Fourth Seal, our forecasting service, the daily trade signals, the trade program, everything you want, or everything you could possibly want. And you can try anything that we market and suit yourself. If it suits your style of trading, then you can subscribe for it in due course. Okay, so that's that, and I wanted now to move to the charts. And the first chart I'm going to show you is gold. Gold's the big story at the moment. This is a weekly chart of gold. This is one that I've restored some of the numbers to. Of course, as these markets move, the Daniel Code numbers come off it. But you know, we've had this massive drama in gold this week. Which has been great fun for us futures traders, but pretty awful for those folks who are in the buy and hold camp. And as I said, we've got my friend Boyd from Canada with me today. Boyd's a gold bug, gold buff, great supporter of it. A wealth advisor, has lots of clients invested in gold bullion. Boyd, I don't mean any of this to be critical of you. In fact, I know that you're a member of the Daniel Code and follow our analysis and signal closely to help your clients. This will just demonstrate the difference between traders and investors. Last couple of weeks ago, in fact, it was just about right in here. Let's say you can see the note I've got at the top of this, that we have a small number of private clients for whom I do special charts and provide commentary on a weekly basis for any markets they're interested in. If any of you would like to take advantage of that service, you can email me and I'll be happy to talk to you about it. And these people are mainly proprietary traders and brokers and hedge fund people. Way back in June, on the 6th of June, in fact, the private client commentary said, consolidation continues with stops being run at both the high and the low. This is gold, of course, we're talking about. And a weekly close below 1178 argues for weakness, not strength. And that went out to the private clients on the 6th and the 7th of June. So there's no surprise, because these Daniel Code ratios, we can use them to gauge strength and weakness in markets. A very simple visual way of looking at markets. And the 1178 is the 59.3 retracement. When I said at the beginning that time equals price equals time, that's the Daniel Code equation. We actually use exactly the same ratios. All these numbers come from the same piece of literature, and we use the same numbers for our market retracements, which are uncannily accurate, as we do for our time cycles, which are equally accurate. When we get a market that's reached a Daniel Code, a known number for a Daniel Code retracement and a known number for a Daniel Code time cycle, we say that time and price are squared, by which we mean that the market is at a known juncture of time cycles and price signals. And when that happens, a reversal is almost inevitable. But we can also, on a less sophisticated basis, we can simply look at our price cycles and we can determine market strength. And basically all of the cycles along to 59, we say that they are mere retracements that will, the trend, the probabilities are the existing trend will be maintained. But once they breach that number, usually on a closing basis, consequences follow. And the consequences are that this market had breached this number as far back as June. We're advising our private clients there'd be further weakness in this market. That was the high value probability. So then we moved on a couple of weeks here. We got a minor retracement and it started to move off. So at this stage, the black line at 1151.5, that's the last retracement, the Daniel Code black line retracement. That's the last support or resistance for the existing swing. And once that was breached, the odds were very high that the whole swing, which goes way back to this low here, in November 2014 was going to be taken out, and of course that's exactly what happened. The point is that way back in here somewhere, I was talking to one of our clients, in fact, who is with us today, a very dear lady, great friend of mine also, who was telling me that she was heavily invested in gold bullion. And without wishing to be provocative, I said to her, why? And she said, well, it's going to go up. And I said, is it? And yes, it's going to go up a long way. And I said to her, why is that? And because it is because of a belief system, basically. And this really, there's two great markets where this belief exists. One is gold, and one is the equity indices, you know, the S&P, the Dow, all of the indexes, and of course, the Australian share price index. And with the indices, what very few people realize is that the stock exchange creates these beautiful charts that are always rising from the left lower corner to the right upper corner, and they go back years and years and years, and this chart has never failed to rise, and it's never failed to recover when it's had a drawback. And the stock exchanges and the brokers cite this as proof that you should be dedicated to the proposition of buy and hold. That if you buy stocks and hold them long enough, they will inevitably go up, because this is what they've always done in the past. What they don't tell you is that index, those indices, actually go up all the time because they are engineered to go up all the time. And the stocks that you're seeing in the index today are not the stocks that were in the index 5 years ago, 10 years ago, or 20 years ago. And what they do is that companies go broke, go bankrupt, and they are removed from the index and replaced with the hot new thing. And stocks that trade below a certain dollar value for a period of time, they are taken out also and replaced with the hot new thing. And this is called rebalancing. It's not rebalancing at all. It's re-rigging the market. And if it was done by anyone other than major institutions, if you and I tried that sort of thing, we'd be heading for a jail cell. But because they're major institutions, not only does it go on, but no one ever talks about it. So you need to know that it's a belief system created artificially, indeed, in my view, fraudulently. Unfortunately, the same thing happens in gold. There is a huge vocal push for gold. It's hard to open any reasonable commentary document or website without having a blurb for gold. Gold is the only real currency. Fiat currencies are not real currencies. Gold is the only real store of value. Don't trust the market. Don't trust your banks. Don't trust anyone. We've got this gold paranoia going on constantly, and we go better than that when gold bugs don't like what they see. That is that the market is going down. Oh, well, it's a conspiracy. There's always a conspiracy. JP Morgan's manipulating the market. Someone else is manipulating the market. And many years ago, when I started writing for the Daniel Code and publishing my material, I made this point about gold, that gold, I love gold. People say, you don't like gold. I love gold more than anyone. I'm a real gold bug, but I'm a trader of gold. I trade gold futures constantly and incessantly. I love trading gold. It's a great trading market. And I trade more gold through futures than most bullion dealers will see in their whole life. So I just have a different approach to it. I like gold as a trading market, but it is in fact a commodity. Yes, it has some wonderful qualities. It's not destroyed by processing. There's limited supply. I understand all that, but it's still a financial market, and financial markets fluctuate sometimes violently. And if you're in the buy and hold camp, then you sit through these pull downs in the firm belief that the market will always go back up. And it may, but you can't prove that to me. And a much safer view, a much safer way to make money and maintain your wealth is to trade these markets. So, buy when it's going up, sell when it's going down, get the signals from the Daniel Code and follow the markets. My general rule is the closer you are to the market, the safer you will be, which is why we trade pretty much 1 to 3 day trade. Sometimes we'll get the 5, 7, 9, 11 day trade, which is a great bonus. But we're always trying to stay close to the market. So that was a moment of serendipity in my conversation with this lady. And it is with all gold bugs. They have a belief system that gold will go up. They can tell you all sorts of things like China is buying so much gold. China is storing gold. The reserve banks are storing gold. Then they have absolutely no way of proving that. But it's printed ad nauseum. It becomes gospel for that reason, the greater fool theory. And then eventually something happens, like they find out China reports its gold reserves, and they're not as great as they expect them to be. So that is now an explanation for why this market went down. In fact, that's not an explanation at all. The market went down because the price structure had breached some key Daniel Code levels, and I'm trying to make the point that as far back as June, the beginning of June, the first week of June, we told you that this market's bias was all to the downside, and a fast move was not out of the question. And I'm going to show you more of that. So there's the weekly chart, and I'm going to show you where we think this market is going and when. So for that, I'm going to turn to some documents from my colleague Frank, who assists me with creating these fourth seal. We call it the fourth seal. It's our forecasting technique. If you just have a quick look at the Daniel Code website, then we should be able to show you what we have there. And you can see this is the fourth seal. We do DAX, S&P, crude oil, natural gas, copper, T-bonds, the US dollar index, and gold. Frank, he's a Belgian chap, one of my students, very, very clever young man, came to us in Taupo to start to learn this stuff, and got very involved in the fourth seal. You can call it the fourth degree if you prefer. And it's a very, very accurate way of forecasting future price movement. And he's sent me these charts. So let's have a look at what's been happening here. And let's start with the 24-day chart in gold, which has come up here. You should be able to see this shortly. It should have changed now. And this is Frank's 24-day chart. It looks terribly complicated. It really isn't. What it is, it's a build-up of the various time cycles and price cycles, all from the Daniel Code. And you'll see when I move on to my own charts, I'll show you how all of these price movements were so precise and exact. And what we have here is coming up now is a cluster of time cycles. There's a 59, 62, 44, and then there's another group just after them. Remember, we're starting to look by looking at the 24-day chart, which is effectively 24 trading days. It's effectively close to a trading month, and that's where we start. Frank thinks that we're going to get a low. He's been saying this for months, that we're going to get a low early in August. Let me just Get rid of that one, and we'll go to the next one, which is the 12-day chart of gold. And don't go away, Kurt. I've got a Huey chart to show you. You asked specifically for what was going to happen with the Huey. I've got a chart to show you. Here's the 12-day chart of gold. You can see that he's forecast this stuff. He's been talking about this going in to make a low in early August. He's been doing that for months now. And these are his targets, 1001 or 933, probably for the second week of August. That's our 12-day chart. And then we'll move to the 6-day chart. Here it is, getting in, focusing a little more tightly. And he's got a fourth seal line, a forecast line that's running down through the time period that he sees, and he's looking down to 933 for that number. It doesn't have to get there. There are many fourth seal lines, and getting too far ahead of yourself with the forecasting business is always hazardous, but he does a great job for us. He's very, very good at this stuff. I trained him, and a lot of you know him. Sage and Daryl are with us today. They'll know him. Might be Peter Norton. Peter Andrews is with us. He knows him. He was at that Tapo tutorial in 2011, I think. A very bright young man. Never seen a chart in his life until he came to his Daniel Code tutorial. And of course, those people make the best students, because with most people, our biggest problem is getting rid of everything that they think they know, that they've learned for the last 30 years or so. And in fact, I have some interesting commentary going with Brian in New York, who's a very, very senior options trader and hedge fund advisor, who's absolutely overwhelmed with the Daniel Code after coming to our LA tutorial. But he keeps saying, I've got to get all this stuff out of my head that I've been learning and forced to learn over the years with the Market Technicians Association and the rest of the crackpots out there who think they actually know something about trading. Anyway, so there's Frank's chart. He's also given me another one to show you here on silver. Here's the 24-day chart. It's got a much closer fourth seal target. And what he's looking here for is a break of the existing lows, a marginal break. And there are two fourth seal lines there, which we expect will give it support. Silver looks stronger than gold. Silver's certainly a lot stronger than gold, which is kind of interesting. Here's the commentary part of it. I'll just blow this up for you, so you can see your chart your screen should have changed. And this is what you get on the fourth seal from the Daniel Code website, if any of you would like to subscribe to it or take a trial of it. He's been talking, as I said, for some time about looking for that 62 cycle low in August. His commentary for this week was nothing changes, still on schedule in important August low, important I should say, in fairness. Frank is a Belgian gentleman. English is not his first language. Sometimes Terry or I will correct these little spelling problems, but he does very, very well. And I think it adds a bit of flavour to it, Frank. So we think you're great, my friend. You do a great job for me and for the Daniel Code clients. And he said here, this is the first potential time zone where the 24-day chart could form a low. Until then, odds favour that we go lower. And of course, we have. So that's the sort of stuff you get on the fourth seal analysis. It shows you the charts. He does them in various time frames, and you don't have to just wait for the low. If you know what the trend is from the fourth seal and you bias your trades that way, I've done that in a webinar for you before, and you about quadruple your equity curve. I'll do that again someday if someone will remind me. Okay, so we've done all of Frank's charts there, which is really good. So we can minimize all of that. Here's what's happened in gold so far. There's the weekly chart, and we can now move on to see what's happened here. I've got to show you Huey. Kurt asked for Huey. Kurt, this will make much more sense to you after we've done the analysis on the gold charts. I think I did it on a 12-day chart. And here's what's happening with Huey. The gold analysis is much more going to be much more detailed, Kurt, than Huey, because we only have data on the Huey back to 1998, whereas we have much more data on gold. And of course, it's the previous data that tells you where these markets are going to go. And look how accurate this stuff is. These numbers you see down the right-hand side here, these red numbers and black number at the bottom, these are the Daniel code retracements, which go to a fixed ratio of the major swing. And in this case, we're working off the swing back to here, which was November 2000. And from this swing, you can see, I'll just get my, I don't have a highlighter for this function, this will do. You see this market topped out here in September 2011. We were actually running a tutorial in Colorado Springs at the time, and one of my clients asked me, is that the top for gold? We had sell signals on the day, blue line sells on the day, said, is that the top for gold? I said, yes, and this was under par. Sage, you know, Jeff and his lovely wife, and he was a big holder of bullion, the gold bullion, and he went away from that tutorial that day and came in the next morning and told me that he'd sold 80% of his gold bullion, a couple of points off the all-time high. So he's been a pretty happy chappy ever since, and largely dedicates himself to playing golf. Very good golfer. Our friend under par, Jeff, his name is. So anyway, you see from that high, the market came down. It ignored the first Daniel code number, went straight through it, ignored the second one, gave it a little bit of recognition by closing very near it, then did a key reversal bar at the 370 level, and it went back up, and it tested the 29% retracement from the bottom. And that's what markets often do when they ignore a Daniel code number coming from one way. They'll very often go back and test it from the other side. So it did that. Remember, this is a 12-day chart, so this is basically half a month, each of these bars. It'll fall away then, and then you got this rally up here which failed, and it started on its next leg down. It came to the 50% retracement at 337. That stopped it for a month. That's 2 weeks. Here's your next 2 weeks. It continued on. It got the 280 retracement. It shot through it, ran back up to close near it, opened its next fortnight right at that bar, had a little down bar, came back and tested this number again. All of this is just saying to us, I know what the number is. Markets know these Daniel code numbers, which are largely secret. We are a very small group. Not a lot of people know this stuff, but nobody except Daniel code members use these numbers. And you can just see the markets know them and gravitate to them. They're like magnets. So down it goes, rallies 1, 2, 3 periods, straight back into this 280 number again. Has its high right there. Next period has its open and its high right there. Moves away, goes to the next number. This is the 74 number. Stops at the 74. Little rally, wanders around a bit, and then starts to move through. Breaks through its 190. There are some other numbers under here, Kurt, I haven't put on this chart. This is just the other places where this chart has rallied are the cycles from the penultimate low. That's the low before the low. But I've tried to keep this clear so people can understand. Little rally back up, little push through our 190, and down it goes. So the next number on this chart on the Huey is 101. Do I think it's going to stop there? I don't know. That's very important support. It's black line support, but that's only because we don't have data going back terribly far. And as we move on now, I'm going to show you the S&P. You'll see DK. Any ideas on crude, John? Mate, I've got ideas on everything. If you want to know where crude's going, send me an email before a webinar, and I'm more than happy to give you the analysis. I don't know, DK, if we will have time today. I've got an awful lot of stuff to talk about, and I know that folks can't stay with us all night, much as I'd like them to. But anyway, let us move on now to gold, and Kurt, you'll see these additional numbers that I'm talking about here. So let's start, shall we, with the 24-day chart in gold, and here it is. So what we see here, this is running all the way back to 1999, and we have data on this. You can see where this trend channel starts way back here in 1975. So we have a lot more data for gold. The point I want to make to you here is that you can see this, these blue lines here. This is the very long-term Daniel Code trading channel. It doesn't actually tell you anything other than where mean reversion is going to come in. And mean reversion for this market is going to be somewhere around 960, 950, 960, those sorts of numbers. And we start off with our 24-day chart to get gives us perspective. If you're a gold bug, let me crank this in so you can see it. Look, gold's still at a very, very high value. And this is still only a retracement in any terms. This is the swing goes all the way down to here. So this is really, I know it may not feel like it, particularly if you bought gold in recent times, but this is only a retracement, and it will develop into a more complex retracement, I'm sure. But as it approaches, this is our 24-day chart. Here's the Daniel Code trading channel running down here. The shorter term one, it's observing that pretty nicely. Once it breaks out of it, we can go and expand that from 1 standard deviation to 2 standard deviations. Remember that you need to use the specific Daniel Code settings. Here we had the breakout above 1 standard deviation. Here we ran down to 2 standard deviations, then back up to 1 standard deviation here, and it's heading down again. Let me take these blue lines off so they don't confuse you, and we can concentrate on these price numbers. Here's this March high 2011 in gold. It starts running down. It's very much like the Huey. It runs through the first numbers, and we've got 2 separate swings on here. So we've got 2 separate lots of retracements. These are the techniques you need to use when you're doing this analysis. We've got 1 swing that goes all the way down to this low, and then we've got another swing that goes down to this low. This is the low after the low. You can use all of them, but you don't need to get too many lines on your chart. And once I've done that, I use a chi-squared test to tell us which are the most probable ones to be hit. So it runs through the first retracement, closes there at the 1382. Remember, this is pretty much a monthly chart, so all of these signals are important. It's telling us I know the numbers, I know where they are, and I'm tracking them. Next bar down, dives down. The number we were looking for at that low was 1180. The close was 1179. The low was 1179.4. That's how accurate this stuff is. Roars back up. Same thing it did. We showed you on the Huey. It missed the 1427 on the way down, so it's going to test it from the other side. 1427.6. The high of this bar, 1434. Then it comes down again. It hits the 1180 bar again. It goes back up, and now this time it doesn't test the 1427. It tests the 1382. It's telling us that there are 2 different cycles at work here, 2 different time cycles from 2 different swings. And it's saying, I know about both of them, and I'm tracking both of them. That's how these charts talk to you. Down it goes, 2 bars down, hits the 1239, gets support off that for a month and a half. That's the larger cycle of the 2. Down it goes, dives down, turns prematurely. It should have got down to 1112. It turned before that to show us it's a little bit bullish, and it rallied up. Hit the 1239.8. That's where it stopped for the month. Next number up on the other cycle was 1297.3. Got to 1307 and failed. Down it comes. They've spent 4 months. 4 months chopping around this 1180 number. So, there is nothing random about this. This market is yelling at us. I know what these numbers are, and I am tracking them. And that's how charts talk to you. And you may think I'm nuts, and that may well be true, but only a madman knows the joys of being mad, as one of my dear ex-father-in-laws used to say to me many years ago. But that's what charts do, and that's what markets do, and you prove this stuff by observation and demonstration, and that's what I'm doing to you. So it then dived down, it ignored the 1112 number completely, and it stopped for the week 1088.50. The close today was 1089. One less than 1 point away. So this market is tracking these Daniel code numbers exactly. It knows there are two sequences, and it's following both of them and alternating. The next number down is 1012, and below that it's 933. Is it going to get there? I don't know. We do not have the gift of foresight, but we have rules in our trading system such that whatever it does, we're with the trend, and we have a very good idea of where the next level of support and resistance is going to be. Just as a point of interest, there is a 62 time cycle expiring in 0903, which is typically a support cycle. So there was our 24 cycle. The next chart to look at in gold. I hope you gold bugs are enjoying all this. I know it's going to go for a while, but I've got so much to tell you today, and we keep running out of time. I'm just going to keep going today. I hope you can stay with us. And this is the gold chart. Same thing. Here are your two. There's one retracement group. That's one range. Here's the major range down to here, and there's many more below it. But they're the ones we're working on, and more importantly, they're the ones the market's working on. Here's your high. This is September 2011. It runs along. These are little false breaks, little rally. Now it's going to get Fed income. There's two. These are 6-day charts. There's two periods right at the 1554 number. Few bars rally. Down it goes. Breaks down, tries to stabilize at 1370. You can see there's a low at 1370. There's a close in there. There's another low at 1370. And another close at 1377. Again, this market's saying, I'm tracking this range. I know what these retracements are. It breaks that. It shoots through, ignores the 1302, which is the 50% retracement of the major swing, goes down, hits our next number, which is in here, 1186. Key reversal bar there, rallies back up and tests one of the minor cycles from the underneath. Goes down, 1186, hits it again. Same thing. Goes up to the 1370. Weakens, comes down. There's its next hit at 1186. Rallies 2 bars, breaks it, and it switches to the other cycle. It's now on the minor cycle, 1138. That's the minor cycle. That's the one that runs from the high down to the 2009 low. That's the alternate cycle. And from there, it rallies up. It tests the 50%. Remember, we said it ignored it on the way down, which is unusual. So it tested it from the underside. That's how it validates this. And that's how it can talk to me and say, I know these numbers. I've just hit the minor cycle and bounced off that, but I know where the major cycle is as well. And I'm testing it to show you that. Down it goes, 1138 is where it is. Bounces off that, little bounce up, and now you get that break, and down it goes. Okay, and there are your next numbers. The major cycle, the next number down is 1001.6, and the next cycle in the minor cycle is 981.5. All right, there's the 6-day chart, and that's what's happening in gold. If you want to know more, you can subscribe to the Fourth Seal in Gold, where Frank updates those every Monday. You can be subscribing to the Daniel Code, where you can see the gold charts updated twice a week and all of the details of buy and sell signals. Remembering that the markets are correlated. Huey, gold, silver are all correlated to an extent that a signal in one can be taken in any of the others if it is elected. Okay, that's gold, and that was the story of gold. Let's now move on, because I want to talk to you at some length, or I'll try to keep it short. We've only got 10 minutes, and we're going to go way over that, folks. SP trend. Let's move to our big chart. This is our 24-day chart. And I want to show you this currency that I'm going to talk about today, which is Aussie USD. Now, if you're not concerned with this, if you don't deal in the Australian dollar and you don't trade it, it doesn't matter, because please pay attention to what I'm going to tell you, because people have no concept of how much currency affects your wealth, your life, your family. This market has declined 35%. Up in here, 2011, 2010, all the way through here, this was trading above par. This is trading at more than $1 US. Now, how the Australian dollar could ever be worth more than $1 US is completely beyond me. It's a huge island, Australia, most of which is desert, but it happens to be very, very rich in resources. And this period was the greatest mineral export boom in the history of this country, and maybe of any country. And Australia is a huge producer of coal. It's one of the biggest producers in the world. Iron ore, where it is the biggest producer in the world. Gold, diamonds, lots of other precious minerals. And it digs those out of the ground. Natural gas, it's now when the next Barrow field comes on stream in a few months, Australia will be the largest natural gas producer in the world. And what it does, with typical short-sighted view, is it digs up all this wonderful country, sticks it on ships and sails it off to Japan and China mainly, and sells it there. So no value added, nothing very too enhanced about it. Let's just dig it up. It's what we used to say about New Zealand. The average mindset is if it grows, chop it down. If it moves, shoot it. And unfortunately, there's a lot of that about Australia. But anyway, in this period, the greatest mineral export boom in the country's history, maybe in the history of the world, we were selling still are selling massive amounts of mineral. Iron ore up over $100. Uranium's always high, of course. Coal prices were very high. But all these contracts are in US dollars, so Australia has a massive inflow of US dollars. Why, you would ask, would the Australian currency be high? If there's a surplus of US dollars, the currency should have gone down at that stage. And why it's gone up in the stage where all logic tells you it shouldn't be there is one of the great mysteries of the world. But nevertheless, it's an invitation to hedge your exposure to currencies. Now, at about this time, not so long ago, just about in here somewhere, I was in Sydney seeing my accountant, and I had a meeting with him and some of his partners and executive staff. And after we'd finished with the business of the day, we got round to talking about this and that and the other, and they were telling me how excited they were about their huge profits they were making in the share market. These are intelligent people, educated people, vastly experienced people. And I said, well, tell me about this. Oh, we've got all this huge portfolio of shares, and we only buy the blue chips and da-da-da. And I said, well, do you get any advice on this? Who's your broker? Oh, no, we don't use brokers. You just have the platform with the bank, and you can buy and sell your own shares. We don't need to pay brokers. This coming from accountants, mind you, who charge you to pick up the phone and say good morning. Anyway, they were all totally and utterly invested, even at the extent of, I can remember one of them saying to me, John, you've got a lot of cash in these accounts. Nobody's got cash. I said, well, I do. I'm a great believer in having cash. And he said, oh, well, we don't. We all our cash is in the stock market, and we just live on credit cards and pay them off at the end of the month, so we don't have to pay interest. But the general bullish tone of this was just so intense. I said to them, have you ever thought of hedging? No, what's that? And I said, well, it means if the currency goes down or the market goes down, you guys are going to lose a lot of money. No, never happened. BHP, Bank of ANZ, Bank of Westpac, never happened. Well, it has happened, and it's happened in a way they don't even recognise. The Australian share price index isn't that far off its recent highs. It was flirting with 6,000. Everyone's terribly excited about that. You notice the bias. It's always all news and all market commentary is biased to the bull side. It's just got to suck more people in all the time. But in fact, the Aussie has fallen 35% this move down here, which means that if you happen to own assets in Australian dollars, no matter what you think the share price index is at, you've lost 35% of that wealth internationally against the US dollar. You've lost 35% of the value of your house while everyone's yodeling about house prices going up and up and up, and they are going mad. It's a real property bubble in Sydney and Melbourne. They're up 4 and 5 and 6% per month. I think Sydney's up 22 or 24% in a year. Absolutely crazy. And what they don't realise is they've already lost 35% of that value by the currency depreciation because they don't get proper advice. They don't know about hedging. And what we see in these situations in bubbles and boom markets is the populace, the great unwashed who know nothing about markets, get hubris and they think they can get all they need to know from the newspapers or from tipping sheets. And the amateurs become professionals. They don't need a broker. They don't need advice. And the worst, in extreme cases, they might talk to a, quote, wealth manager, a financial advisor, and they don't know anything. Then, of course, they're going to lose their tails, as they're doing right now. And the beauty of it is they're not even aware of it. So that's interesting. And in fact, even the gold bugs, don't forget, Boyd, I'd like to use this argument and say, oh, gold's doing very well in the euro, or gold's doing very well in the Aussie. Yes, it is, but the Aussie's off 35%. You're dreaming. Measure your wealth in US dollars. Don't worry too much about the rest of it. Okay. Hank's with me. Good on you, mate. We've got some believers here. But anyway, let's move on. Here's the Aussie dollar. This was the crazy high in 2011. I've got to admit I was early with my hedging. I started hedging this thing in about March 2011. And I maintained those hedges all the way. They looked pretty boring for a while, but they're certainly paying off now. But you watch this thing as it came down. It came out of this high, and it bounced at the first retracement. Same thing here. Let me scrunch this up so you can see it's very much the same as gold. And this is the universality of markets. Markets do the same thing all the time. And here you have two swings. Here's the first swing down to here. Down to November 2008, and here's the biggest swing down to April 2001, and there are more swings before that. But it has to correct the first swing first, so that's what we've got here. We have the correction for the two swings, and the numbers on the far side here are the major swings, and the numbers slightly inside that are the minor swings. So look what this thing does. It comes down here, and it bulls straight through the first annual code retracement, 9537, just runs straight through it, does a key reversal bar and reverses. Now it starts to get some sense about it. Now remember, no one knows these numbers. They're secret. You're probably the only people on the planet who know these numbers. These are not fibs. They're not old highs, old lows. These are Daniel code proprietary numbers. 9573, it moves on in June 2012. It comes down and it makes it low at 9581. 8 ticks away. Not bad in a market that's sitting at almost 10,000. Now it's starting to pay attention and observe these numbers. And it rallies for a few months. Excuse me if you think I'm taking too long with this. I mean, I am so amazed by this stuff. You should be too. And all markets do this exactly the same. Whatever your local currency is, it will do exactly the same as this. It will run to and from these Daniel code numbers like markets. So if you understand this analysis, you'll be able to do the same thing on your own currencies. Down it comes. We're on a monthly chart, 24 days. Then it finds the next number, 8822, does a key reversal bar there, rallies, goes up, fails, comes down. It closes this month here, which is January 2014. We've got two different numbers here. We've got 8822, and it closes here at 8820 to say, yes, I know where the minor retracement is. It does a key reversal bar at the larger number. It rallies up It has a low at this group of numbers here. It has another low there. It has an inside bar. It closes at the 9206. It opens there and it runs down through the next number. And it closes near the 8714. The next bar, it gets more precise and it hits the 8543. Exactly the low of this monthly bar, 8541, 2 ticks away, folks. And it's the same thing. It's saying, I know these numbers. I'm on it. I'm tracking them. Down it goes, 2 more months down, 8071 is where it gets to. Now, all this time, newspapers are publishing, the 24 Economist poll said this, that, and the other. Haven't got a clue, wouldn't know, just dreaming, just guessing. Economists don't know anything about markets, okay? The reason we have financial papers and financial websites is so we can have some humor in our lives. You can see the great unwashed being paid millions and millions of dollars to pontificate their views on markets about which they know nothing. Okay, so don't worry what the economists say. Don't worry what Elliott Wave says. Don't worry about Mr. Elliott. Don't even worry about Mr. Gann. All you need to know is what the Daniel Code says, and you will be much better off following that. Same thing, here we go, down it goes, breaks to a minor cycle, rallies, goes right back up, closes the high for the month, 8071, we were looking for, it got to 8075. Again, it's telling us it knows these numbers and it's tracking them. And now where is it? The low here is 7328 today. We've got 2 numbers there, 7338 and 7315. And the close today, folks, was 7328. That's how exact and precise this stuff is. I'm going to run through this a little faster now because we're getting out of time. I hope I've made the point to you that these markets are terribly precise and we can measure them with a very high degree of accuracy. And once you know the sequence that they have been running at for years and years and years, remember this sequence starts back in 2011. August, we're almost up to August 2015 now. So this sequence has been running for 4 years and it's just been running off these Daniel Code numbers non-stop. Where does it go from here? I don't know. This may be a low. We'll find out. If not, it breaks this support, then it's 65.64 followed by 63.98. And there are more numbers below that. But these are the high probability numbers around the 63 to 65. I think the bad news hasn't filtered into Australia, a country of eternal optimism. They have no idea how bad things are going in the economy. Nobody has woken up to the fact that you've got governments screaming for more revenue, more revenue. This is already the highest tax country in the world, and governments are saying we need more revenue. At what stage do people start saying to their leaders, when you're in a hole, stop digging? Don't worry about more revenue, stop spending. We've got this ludicrous hundreds and hundreds of millions of dollars being spent by politicians, gravy train trips all around the world. It is absolutely scandalous. It's ridiculous. So, but there's no choice, no chance politicians ever stop spending. All they do is let it blow. They don't care. They're there for the good times, and they hope that when it eventually all does hit the fan seriously, which people won't recognise until the price of their bloody iPods or iPads, whatever they are, go up. That's about how sensible the great unwashed are. But anyway, there was your. We ran that for you. There's the 6. Let me show you really briefly the 12 and the 24. This is that was Huey. Kurt, you've got a better idea now where you're going to go on Huey. Here's Aussie USD. This is the 12-day chart. I won't belabor the point. You can see it yourself. Target recognition, Daniel Code target recognition. Missed that one, we'll retest it the other way. Missed that one, retest it the other way. Dive to the 50%. Rally into a minor cycle, which I've left off so as not to confuse you. Found the 74.94, turned a bit before it. Turned at 75.33, is telling us it's bullish at that stage. Little rally up, didn't make the 82, and now it's taken that out. The next number in this sequence is 67.79. And finally, we'll wrap up by showing you the major cycle here. This is Aussie USD, and there was a number way below these. No, perhaps not. It was this one is the other dominant cycle, right down all the way to 54. This is the 24-day chart, and you can see it's done exactly the same thing. Target recognition, same again. Break down to the next one. Little rally, target recognition of the 88, key reversal bar. All these charts are exactly the same. And you need to do, though, on these big moves, you need to do more than your daily charts. You don't get to see this. So, folks, that's all we have time for today. We're 5 minutes past. Richard Harris, you'd like natural gas. If you'd send me an email, please. Let me put my email up here for you, which should be up here somewhere. If you guys, any of you want, I thought I had an email here for you. No, maybe this one, last chance. Trend will be here. SPX, there it is. Boy, lucky last. jneedham@thedanielcode.com. Richard Harris, if you would send me an email telling me you'd like to know about natural gas, I can have charts prepared for you at the next webinar, which will be 2 weeks' time. What I can tell you about natural gas, if you didn't already know, is that for today, we had a sell signal in natural gas. And I think, let me see, natural gas, yes. Had a sell signal in natural gas today, Richard. If you didn't get it, you didn't get it. You should have. It's on the Daniel Code website. A nice sell signal in natural gas, got the money. Very good. Okay, send me an email and I'll be happy to have an in-depth analysis ready for you on that at the next webinar. Okay, DK, the same. Send me an email, please, what you'd like to know about crude. I can have that ready for you as well. Okay, and that's pretty much it for the day, folks. I thought we were going to go an awful lot longer, but I'll probably close this webinar and say, crikey, I've missed half of what I want to talk to you about, but really very, very serious, these major currency fluctuations. I'll just leave you with this view of the Aussie USD. So this can happen to you too. Don't think this is only happening in Australia, but that means all these people who think their house values are going up so well, they're not, folks. In international terms, you've lost 35%, and probably a lot more to come if you weren't hedged. The great unwashed are never hedged. And that's what makes this game so good, Janet, that we don't have to worry about gold going to 5,000. We trade gold. We're always with the trend. We get paid when it goes up. We get paid when it goes down. So that's it for the day, folks. Thank you, TJ Mullane. Enjoyed our webinar. Glad you did. I hope we'll have you pleasure of your company at the next webinar in 2 weeks' time. So, folks, thanks to all of you. And Sage, of course, as usual, thanks to you for supporting me. And Brian, glad you enjoyed that. Matt, I'll see you you're on the 8:10 flight tomorrow. I'll be at Coolangatta Airport to meet you. And I'll look forward to seeing you guys tomorrow. And now it's Friday afternoon, which means it's time to start chilling down the Bloody Marys and thinking about what a great week's trading we've had. Thanks, folks. Do email me if there's anything you need to know, and do email me if you'd if you'd like to get trading with the Daniel Code. Richard, great. I'll have you hopefully with us in a fortnight. Thanks, folks. That's it. I'm going to close the webinar. Do enjoy your weekend. I know I'm going to. I got a couple of great mates coming up from Melbourne who are at the LA tutorial, and we're going to ponder the markets, what they mean, and probably have a few little drinkies as well. So thank you for being with us, and I'll look forward to having you with us next time. Rob, I'm glad you're doing well over there in New Zealand, mate. Glad you were with us. Okay, all the best, folks. Bye-bye.